Well, hello, everyone. My name is Ed Newton. I'm a CPA and Certified Financial Planner, and I'm president of Newton Financial Network. On today's call, I'll be talking with Troy Patton, who's our portfolio manager for the Newton Financial Network. In addition, Troy is also a mutual fund manager. He runs the Archer Funds family of funds. Plus, Troy is also a CPA and an accredited Business Valuation. Today, what we were wanting to do is to discuss the markets and the current investing climate as things are currently standing. If you have any questions, we'll open up the lines towards the end, and you can ask any questions that you'd like. Troy, welcome to the call.
Thanks, Ed. I appreciate it. Thanks for having me.
Sure, of course. Troy, it's an interesting time, to say the least, and has been an interesting year from an investment standpoint. We've seen economic growth. It's been small, although steady, which is nice. The markets are up year to date. We just went through a presidential election cycle. We have another one of those debt ceiling fiscal cliff dates coming up. We also have a lot of tentative tax rate increases if Congress doesn't reach a deal on those. That's certainly a concern for our clients. And, of course, the Mayan calendar is predicting the end of the world on December 21st. So can you talk a little bit? Go ahead.
Well, Ed, we ought to just wait to buy our Christmas gifts till the 22nd, just in case we can save some money.
That's what I'm doing. I'm waiting. Well, Troy, can you talk a little bit about 2012 from an investment standpoint and how it might set the stage for us for 2013?
Yeah, sure. Thanks. Again, thanks for having me, Ed. I'd like to talk about 2012 just really briefly, although, I always hate driving down the road looking in the rearview mirror because, what's already happened has happened. But as some of you maybe on this call know or have heard me speak before, I always like to kind of give a little bit of a rearview picture and say, hey, were we right or were we wrong in 2012? And a couple things, frankly, we're right on the money about. And a couple things we were a little bit off about, and I'll explain those as well. So, 2012 is actually ending up almost right on target. If you remember in some of our speaking engagements, we said we'd end up the year about 1425 on the S&P 500, maybe 1450. In fact, we could even get as high as 1600 as long as we had everything moving forward, politically. Unfortunately, we have so many irons in the fire right now, regardless of which side of the aisle you belong to. There's a lot of things going on. Just like Ed was saying, we have a lot of tax changes coming up. We have the sequestration, fiscal cliff looming. We have the debt ceiling in February. There's just a lot going on. But a couple things in 2012. I think as far as the equities go, stocks in general, we were right on target as far as the amount of return that we expected. In fact, with that being said, we were right on base as well with emerging markets. We thought some of the emerging markets, as far as the currencies, would do really well, such as Australia. Well, Australia is not necessarily an emerging market, but Australia, Indonesia, Mexico, the peso, some of those currencies doing well. Sorry about that, guys. One thing that we fell short on is we really underestimated bond and credit returns, and in doing so, I really thought, in fact, we manage an income fund, NOAA mutual fund income fund, and that income fund, I really anticipated it to return somewhere around the 4% level, 4 to 5% level. It actually returned above 7%, and that's because obviously bonds did really well. Excuse me, I'm going to cough one time. Okay, so I really think 2012 really shaped up to be kind of the year I really thought it would be. Going into 2013, just kind of to change targets because, again, not to focus on what's already happened, 2013 I think is going to be a really interesting year. I think what's going to happen here over the next even 15 days is really going to set the stage for 2013. And I'll tell you why. If you take a look at the earnings of corporations in America, we always look at earnings basically it's called an advanced decline ratio, and it's our earnings up this quarter from last quarter, same quarter last year, or earnings down. And actually, the average since 1984, earnings have been up about 1.5 or 1.5 companies have been up to every one that's been down. But right now, we're actually facing about right around a 1.25 mark, okay? Which basically says that corporate earnings have softened a bit, okay? And the reason they're doing so, and the reason they're softening, is because there's been a margin squeeze. Profit margins have squeezed in those companies. And mainly it's because they've cut all the fat that they possibly can. It's really interesting. At the same time, we see that those earnings have not increased as dramatically as they have in the past. At the same time, we're actually at an all-time high in terms of corporate earnings to our U.S. GDP. And you say, well, that should be great. I mean, that unemployment's at 7.7%. A lot of things are great. The problem with it is where do we go from here? And that's always the big question. What road signs are ahead or that lie ahead that are going to direct us in the right path? And with the caveat of saying, I don't want to alarm anybody, because I do think equities are going to return somewhere around 8 to 10%. I think it's going to be a pretty much ho-hum year. But in addition to that, we're also going to, I think, have more volatility in 2013 than what we've had in 2012. And just by simply saying that, I do think the market's going to jump around up and down. I really believe that it's possible that we hit a very soft landing or a mild recession in the second quarter of this year. And the reason I say that is because oftentimes whenever Washington gets involved in everyday spending and spending cuts and increase of taxes, there is an adjustment. There's what we call a flight to quality, and it's also a flight to paying down debt, and people really start putting their arms around their money and hoarding everything. And right now, retailers are doing very well. A lot of areas are doing really well in the economy, but they're also not hiring. And we've seen a lot of people leave the workforce. The 7.7%, and this is not politically driven, this is just a fact, that more people are leaving the workforce. In fact, the drop from 8.1 to 7.7 has been 68% attributed to people leaving the workforce. Okay, that's not me making up those numbers. That comes right out of the government. So we have to take a look at that and say, although the economy and the corporate profits are doing very well, there's still a lot of people that are out of work. And unless we can get those people back to work, we're probably going to face some significant headwinds in 2013, at least at the start of the year, and then obviously with some recovery towards the end of 2013. I will say this also. In terms of fixed income, I think this is going to be the first time since 1994 where I believe that fixed income, at least in terms of government bonds, are going to be nearly zero or even slightly negative. And since 1994, we have been in a bond market rally. But I'll tell you, with the 10-year Treasury bond hovering around 1.5 to 1.6%, I'm just not so sure we're going to go a heck of a lot lower. These interest rates are false interest rates. They are being dictated by the Federal Reserve, which is out there buying $40 billion worth of mortgage-backed securities every month. They're taking TARP money and putting it back into the system. Interest rates are basically a falsehood at this point. And again, I don't think Bernanke's that bad of a Federal Reserve governor. I just think it's just a sign of the times that we're trying to keep our interest rates as low as possible, because otherwise our debt would even balloon that much higher in terms of our federal debt. And sorry, feel free to interrupt me whenever, Ed, because I'll get on a roll and start talking.
Yeah, I know you do. That's good. No, this is all good.
Okay.
So let me ask you, Troy, on this.
Yeah, go ahead.
question. As you bring up the idea and you talk about the next 15 days, and I agree with that certainly. If there is no fiscal cliff deal to be had before the end of the year, how do you see that for the markets? I mean, is that good for the markets or bad?
It's initially bad because if we go the so-called quote off the fiscal cliff, which by the way I don't think is all that bad. It's actually something that they came to an agreement to a long time ago, and I never believe I'd be agreeing with Howard Dean. But I believe that the going off the fiscal cliff may be the best answer for everyone. But if no deal is reached and the cuts and tax increases go into place, we will almost certainly face a recession in the second quarter of 2013, almost without a doubt. Because since the history of time of the United States of America, we have never cut public spending by greater than 3.5% of GDP without going into a recession, and that's what we would be doing here. It's never happened, ever, never. But it would also force us as Americans to kind of bite the bullet for 3 to 6 months, and then everything would start coming back. Okay. Because people as well as the government will learn to live within their means if they're forced to. Right.
Right. Okay. And as you were talking about these road signs, the idea of more volatility is coming next year. You see more volatility. Fixed income being basically a zero return or even a little bit negative, as you say. How about spending a couple of minutes and tell the folks how through our model portfolios and how through our work together, you and I, how we protect clients' accounts in these types of high volatility and that sort of thing?
Sure. Yeah, actually, I'm glad you asked that. The fixed income side, especially, I think we are very well positioned in our model portfolios. One of the things that I haven't really spoke about is the U.S. dollar. I continue to believe the U.S. dollar declines due to the increased spending in Washington. Even if they raise taxes and cut spending will still be actually above and beyond what we're bringing in. So which inevitably prints U.S. dollars and therefore continues with the dollar's demise or slide, call it what you will, further down. I mean, it's amazing when the Mexican peso is doing better than the U.S. dollar. So is what we do in our model portfolios, Ed, is we actually hedge against the U.S. dollar, even though, I mean, we're Americans and we believe in this country till the end. At the same time, we have to be prudent with our money, and so we do diversify in some instances up to 18-20% into non-dollar denominated corporate bonds. So, for instance, we might buy Coca-Cola bonds, but in Australian dollars. So, for instance, we did that this year, and amazingly enough, you can get 1 to 2% higher returns in Australian dollars versus U.S. dollars. And at the same time, if the U.S. dollar weakens by 2%, then you made another 2%. And actually, that's one of the reasons why our fixed income portfolios, frankly, have outperformed over 2012. That various scenario. I mean, we bought corporate dollars in Canadian, Indonesian, Australia, Mexican peso, and those of and Brazilian real, and those bonds, corporate bonds, quality grade bonds, have performed well. So. Okay, good.
Talking about the model portfolios and bringing that in, can you give us a little bit of an update of how some of these portfolios, how they've done for our investors so far this year?
Yeah, sure. Yeah, the model portfolios have actually performed very well. One of the things that obviously everyone should know is we don't always take the risk of the market. We generally don't even our most aggressive portfolios. We don't like to see them take over and above risk of the market because our philosophy is people think they're aggressive until the market gets aggressive with them. And so our most aggressive portfolios actually perform very well. into the double digits. And so, we're obviously very happy with that, and it's kept pace with the general markets. And then, working our way down into the middle of the pack of the moderate portfolio. The moderate portfolio has actually been one of even though it hasn't outpaced the most aggressive portfolio, it's actually it's higher than what you would believe it would be against the aggressive portfolio. And the reason is because some of those investments, although we're conservative, just like I was talking about in the fixed income side, the fixed income side is returned, upwards of 7% or even a little bit higher. And frankly, that's something that we usually don't anticipate in that type of a portfolio. So the model portfolios have performed well. And we continue to look forward to 2013, and we believe we've positioned those portfolios to again perform well and take advantage of the areas that we see fit in 2013 as well.
Okay, that sounds great. I'm sure all of our clients are pleased that we're doing as well as we are. Another thing, Troy, that I bring up that I think about is I'm always telling clients we need to stay invested. We need to stay invested. We can't time the market per se. And I'm certainly not a market timer, and neither are you as far as that goes. Certainly we move things around as we see necessary, but not just take everything and move it to cash. How about speaking for a few minutes about, or for however long you want to, the way that we do use the Archer Funds, since you're also the portfolio manager of the Archer Funds as well as for Newton Financial Network, how that in itself is the manner or the way in which we, for lack of a better term, market time from the standpoint of moving the investments and getting the proper allocation for our clients.
Yeah, sure. And I have to tell you, I mean, this is a good question, Ed. Ed and I did not prepare these questions ahead of time together. So, I mean, these are good questions. I love the question about the market timing, because let me just say this. Market timing it really is a poor game to play, because it's not just being right once. You have to be right twice, because you have to know when to get out and when to get back in. A good example of that is Elaine Garzarelli, the famous investor who got out of the market crash in, I forget, I think it was like 87 or something like that.
Yeah, it was early October of 87.
Yeah, it was, okay, and never went back in. And everybody's like, oh, she's the smartest person ever. And then she stayed out of everything. Well, yeah, she just missed about a 300% return, I mean, so, again, you have to be right twice. And there's very few people, if any, that can really do that on a repeated basis. So it's what we try to do in our model portfolios, and even just like this morning in our portfolio managers meeting, we talked about what's working, what's not working, and then we readjust our portfolios on a consistent basis, whether it be weekly, every other week, or every month. We meet like 3 times a week at least to discuss our portfolios, how they're performing, what our positions are, what has changed in the market, so that if, for instance, do we need to move out of some technology and into the Johnson & Johnsons of the world, or vice versa, to take advantage of the market. So we're not trying to necessarily time the market, but we're looking for themes in the market that should perform well with the appropriate amount of risk going forward. Okay, so even though we're not timing the market and going to cash and then going back into investments and that sort of thing, we are actually we're staying invested in different themes to help to protect the portfolios, because it is preservation of capital is the most important part of any portfolio.
Yeah, and as Troy said, we did not discuss at all any of these questions or anything, and it's the first time I've heard the word themes in the market, and even the times we've talked, Troy, I think that makes a whole lot more sense, and I'm going to steal that from you as I talk to clients, because I really think that does hit more of what both of you and I feel about the way we should be handling clients' money is to look for the themes in the market. Right. So I appreciate that comment. Troy, how about talking to the folks on the line, or if they're listening on the replay, that if they like what they're hearing as far as the way we work with clients and how we review and how we continue to invest portfolios for our clients, how that we are willing to give them a second opinion if they would like, and to talk about our free portfolio review and how that works.
Yeah, I appreciate that. One of the great things I think about our company, and obviously I'm biased, but that not a lot of folks do this, is we will actually take a portfolio that you currently have, and we will run it through our parameters here, our proprietary parameters here at Archer Investment Corporation, and we'll take a look at the investments that you currently own, and how not only how they've performed, but also what risk level they're taking. Because it's always interesting when someone comes to you and says, "Oh, heck, I returned 20%." And then you take a look and they were taking 2% or 200% of the risk of the market. Mm-hmm. But the problem is, and this is a true story, like one elderly gal in Chicago who had $800,000 did really well, and she doubled her money before the 2008 downturn. But then she lost about 80% of it. And I remember going through that portfolio review before she had lost that money and saying, "Hey, you're taking way too much risk." And she said, "Yeah, but my advisor is saying that these are great investments and I've done really well." But it's what risk level you have to take to get those returns. So what we do is we take a look at that risk level and how much risk you're actually taking to get the returns that you are getting, and saying, is there a better way? Can you take less risk and get the same returns or near same returns? Because it's all about the preservation of capital as well as the risk levels that you're taking to keep that preservation of capital. And it's not the return of your investment, it's a return on your investment. Okay? So we take a look at all those things and we run them through our parameters, and then it kind of gives us the things that you're doing right and some things that maybe need some improvement or maybe just need a look or a small tweak here and there. And we get that feedback to Ed, and then he can share that with you, as well as some of his own thoughts. So it's really a really neat process that we go through. And the gentleman that does that in our group, he's a chartered financial analyst, which is the highest level of financial analyst that you can hold in the country. And I'd like to say he's pretty smart. So again, we would welcome any opportunity to review any portfolio, whether even if you're with Merrill Lynch or Morgan Stanley. And you know what? It never hurts to have a second opinion on something as most important as your financial process. So,
thanks, Troy. I appreciate that. And before we open up the lines for any questions that you might have for either Troy or myself, let me just say that if you would like to take advantage of that free portfolio review, you can just give Sarah Beth a call in our office at 704-552-8689, and she'll be happy to set up a time that we can talk and discuss and get the information we need, and then get that over to Troy and his folks so that we can give you that second opinion. So Jeff, now if you'll open up the line, see if anyone has any questions for Troy, and see if we can help some folks along.
Thank you, Ed. The lines are open. If you do have a question, just go ahead and speak up and ask Troy or Ed your question. Just identify yourself by first name if you would.
I'm at the point I need to think about all the things you mentioned, and what I realized over the last couple of months that technology stock market was so volatile, and in the way it's going up and going down very quickly. Do you have any explanation for that?
As far as the market going up and down?
Yeah, that quick, especially when it comes down. Let's pick one stock. Let's pick Apple, for example. It went pretty much up to 700, sure. And now it's down pretty much to 400.
Yeah. I mean, Apple's an interesting character. I mean, they have really good products, and there's a lot of stocks. One thing that you have to remember is Mr. Market gives you a price to buy and a price to sell on something every single day. And it's not always the most rational price, because is Apple really worth 20% less than it was, a few weeks ago? And then prior to that, was it really worth 20% more than it was a few weeks or months prior to that? They have the same products, they have the same sales pipeline, but I will tell you something about Apple. I believe that Apple, at least for the next 4 years, is going to continue to have great iPad and iPhone sales, okay? And a stock like Apple, with virtually no debt, okay, and tons of cash, and trading at basically a discount to the overall market, is always a good opportunity to buy a stock like that. And that's why, just for this person asking, it's important to have a wide variety of stocks that you own. I would never own just one stock. In fact, you should own at least 32 stocks, and that's why in our model portfolios, we take a look at the different positions that you do own and try to get a good diversification, because it's not putting all your apples in one basket, as we might say. It's actually diversifying those apples across many baskets in case one apple does go bad. We don't want it to taint the whole bushel of baskets. Okay?
Okay, thank you very much for the explanation.
You're welcome.
Anyone else that has a question?
Yeah, my name is Terry. I'm concerned about investing not only in U.S. markets but overseas, and I guess my biggest concern is uncertainty in the world with terrorist activities and offset of war maybe imminent in the Middle East. And I was wondering, nobody has a crystal ball, but certainly if war breaks out in the Middle East, it's going to affect all markets dramatically. I wondered what your thoughts were.
Yeah, Terry, that's a good question. I always say, if you've heard me speak before, I always say those who, look into the crystal ball usually end up chewing on glass, because it's hard to be right all the time on that. But, the Middle East, I actually have relatives over in the Middle East, and the truth of it is they've been fighting for 1,000 years, and sometimes more intense than others. I do think this is fairly an intense time over in the Middle East right now, and hopefully that will subside. But with that being said, the Middle East does not account for as big a part as the world GDP as that we might believe. Even though a lot of oil comes from there, the oil generally comes from the Saudi Arabia and some of the other places over there that don't necessarily have all the uprisings. And so, although I believe it's important, I'm not so sure it's as important as if maybe a big, large world power. For instance, I think maybe something that's more important would be Europe. Okay, Europe's having plenty of crisis of their own right now. And I think Europe is maybe a bigger concern in terms of can they get their fiscal house in order. And the truth of it is everybody's trying to print currencies and print their dollars and francs and the euros to reduce the value of their currency to make their exports more wanted by other countries. So with that being said, I would actually say emerging markets next year may even return 15%, something like India, versus maybe more 8 to 10% level for the large world domestic markets, or developed markets like the United States, Canada, and some of those. But you know what, the Middle East it really is. It's a world of its own, and you're right. I mean, barring any terrorist act, I really think we'll proceed on beyond this. But I sure as heck hope there's no terrorist attack, because that would wreak some havoc on the markets, especially if it's here at home. So,
well, I I don't think it's a matter of if. I think it's a matter of when there'll be more terrorist attacks. I think we'd be naive to think that we've seen the last of that. So.
They're definitely going to try. I mean, we've seen that in the news. It's just a matter of if we can stop it or not, and how big they are.
Yeah. All right. Thank you.
You're welcome.
Any other questions for Troy? Okay. Well, Troy, I want to thank you for joining me on the call today, and
hey, no problem.
Just to let the folks know that are on here that we'll be doing these kind of updates with Troy about once every 3 months or so, and so that we can continue to get his thinking and the thinking of everyone that he works with, so that you know that we're always looking out for your money. So I just want to thank. Oh, I'm sorry. Go ahead, Troy. Do you have any final words?
All right. That's great. Thank you.
Okay.
Thank you, Ed. Thank you for the invitation.
Oh, you're welcome. We want to thank everyone for being on the call today, or if you happen to be listening to one of the replays, we want to thank you for listening to that as well. If you have any questions or concerns about one or more of these investing topics, or if you would like to see that, get a look at that free portfolio review, or if you want to see what's involved in doing some investment planning for 2012, what little bit left, or 2013, give me a call here at the office, 704-552-8689, or you can always send me an email at ednewton@newtoninvestments.com. Again, we thank you for listening, and have a great day.
Thank you.